The bigger fool theory is an alternative to the discounted cash flow method of asset valuation. It was developed in 1936 by John Maynard Keynes, the Cambridge University economist. This theory rebuts the idea that the value of an asset is the present value of future cash flows. Rather, Keynes argued that an asset's value is determined by what the next bigger fool will pay for it. According to Keynes, there are two elements to successful investing. First, to identify assets that the market expects will be popular. Second, to purchase those assets before the rest of the market. This theory of valuation gives rise to speculative bubbles. A speculative bubble is a spike in asset prices. A bubble is caused when traders buy assets with the expectation that they can sell them at higher prices to other bigger fools. High profits earned by initial investors attract new investors looking for easy money. Soon, buyers outnumber sellers and prices are pushed above their fundamental value. Eventually, some investors recognize that the emperor has no clothes. They sell, other investors follow, and a panic ensues. The bubble ends with a pop. Thus, a third element to successful investing under the bigger fool theory is to sell before the bubble pops. The first documented speculative bubble was the Dutch tulip craze. Beginning in 1634 in Holland, tulips contracted a mosaic virus that caused them to develop colorful stripes. For the next 3 years, tulip bulbs were continuously purchased and sold at ever higher prices. In January 1637, tulip bulb prices increased 20-fold. With prices at such high levels, people started selling their bulbs in order to take a profit. Starting in February, bulb prices plummeted and substantial losses were incurred. Other speculative bubbles include the South Sea bubble of the 1700s, the Florida real estate craze of the 1920s, and the infamous Wall Street crash in 1929. The Wall Street crash was preceded by a bull market in the mid-1920s. Stock prices rose precipitously in the 18 months up to September 1929. For example, General Electric rose 208% to a price of $396. The bull market attracted thousands of new investors. One of those investors was Joseph Kennedy, father of late President John F. Kennedy. He was a professional investor all through the 1920s. Kennedy made a fortune during the bull market and added to that fortune by taking short positions in 1929. He said that he knew that the market had peaked when he received a stock tip from a shoeshine boy. In late October, the bubble burst. Trading volume spiked and the ticker couldn't keep up with market activity. By November 13, 1929, prices had fallen dramatically. GE fell from $396 to $168. More recently, U.S. markets enjoyed a bull run during the mid-1980s, fueled by the recovery from the 1981 recession and a hot mergers and acquisitions market. The Dow Jones Industrial Average rose from a level of 1,700 in September of 1986 to over 2,600 a year later. Monday, October 19, 1987, is known as Black Monday because the Dow dropped by over 22% on one day. The most recent speculative bubble in the stock market was the tech bubble, which popped in 2000. The NASDAQ 100 index rose quickly to a peak of nearly 5,000 in February of 2000. The index fell to less than 1,500 20 months later. The bubble began in the mid-1990s with the emergence of the Internet and an influx of startup technology firms in hardware, software, and telecommunications. The startups hope to emulate the success of early leaders like Microsoft, Intel, and Cisco Systems. Under pressure to report positive earnings, many firms overstated revenues and underreported costs. Flushed with easy trading profits, investors looked the other way in a collective exercise of what Alan Greenspan, the chairman of the Fed, called irrational overexuberance. The most recent bubble was the United States housing bubble. Due to low interest rates and aggressive subprime lending, housing prices rose to a peak in early 2005. Prices started to decline in 2006 and hit bottom in 2008. In December of 2008, the Case-Shiller Home Price Index reported the largest price drop in its history. These historic occurrences demonstrate that, in the short term, prices can increase substantially due to bigger fool valuations, and some investors can earn large profits. But to succeed, bigger fool investors need perfect foresight so that they can sell before the bubble pops. In our opinion, the key to successful long-term investing lies in rational valuation of assets based on discounted cash flows.